Welcome to Zen and the Art of Real Estate Investing. What if you could learn from experienced real estate investors, find out what got them to where they are now, get insight into their daily habits, and take these insights to inspire your own growth? Each week, Jonathan Green shares an in-depth look at the mindful approach to real estate investing. Jonathan is a real estate investor, advisor, and coach, as well as the founder of Streamlined Properties and the team leader of Streamlined Properties on Market, brokered by eXp Realty. Whether you are looking to start from scratch, get to the next level, or just a straightforward and honest approach to real estate investing, Jonathan seeks to provide a free mentorship program you can take with you anywhere. Now, here's Jonathan.
Welcome back to another week of Zen and the Art of Real Estate Investing. I've got another great show for you, and remember, we're Monday and Thursday now, thanks to you. We have episode 63 this week with Chris Larsen. He's going to tell you how to achieve next level income. We're going to talk about a variety of asset classes that Chris invests in now. P.S. If you're not subscribed to the podcast, please do. Leave us a 5-star review. Click all the buttons. Do what you do. Let's get to the show. This is episode 63 of Zen and the Art of Real Estate Investing with my guest, Chris Larsen. Chris is the founder of Principal and the principal of Next Level Income. He's been investing and managing real estate for more than 20 years. He began syndicating deals in 2016 and has been actively involved in over $1 billion of real estate acquisitions. Now it's real estate, car washes, self-storage, and mobile home parks, right? Welcome to the show, Chris.
Thanks, Jonathan. Great to be here. Love the title, too. I remember when I read Zen and the Art of Motorcycle Maintenance back in the day. It's still such a great book.
Yeah, I appreciate it. And I mean, part of having great guests like you who have specialties in areas is to help people understand that there is a mindful approach. And the only way to get there is to learn more from people who've been there before you. So speaking of that, when you were younger, did you have an interest of real estate? And then how did you actually start in real estate?
Yeah, so I had an interest when I was younger in racing bicycles. And I'll tell you about my story, and then also tell you, if you're listening today, how to get a free copy of my book, where I really go into kind of all the different areas and how I kind of formulated really what I would call the framework behind, not only my real estate investing, but just my investing strategy in general, Jonathan. And, my personal strategy, my personal drive was built on the desire to be able to live life on my own terms. And, when I was younger, I don't know if it was because my father passed away when I was 5. We had enough, but, not a lot. Yeah. And I think, that kind of yearning to do things like go on real vacations. We didn't go on a lot of vacations when I was little, if at all. I started racing bicycles, and I just remember the feeling of freedom to be able to leave the neighborhood and ride my bike and, cross this road, ride to my friend's house. And then I was by the time I was 16, I was driving up and down the Eastern coast. I grew up in Maryland. I was driving up and down going to bike races. It's pretty cool. You don't realize it when you're that young and you're driving all over and racing and doing these things. So that sense of independence got into me really early. And that passion that I had was for racing bikes. I went to college and I raced until my sophomore year. And actually in between my freshman and sophomore years, I mentioned I lost my father. I lost my best friend at that time. And when I came back to school, I raced the following year, and it was kind of meaningless to me. I won this race and I didn't feel any joy. And I was like, what am I doing? Riding bikes around in a circle. So I went back to school. I said, that's it. I sold everything, sold all my bikes, quit racing. Said, I'm going to live life to the fullest. And I had this realization that you had to have money to be able to take advantage of experiences when they come along. Whether it's rafting the Grand Canyon for 3 weeks, or, whether it's sending your kid to, a school because they have a specific need that they have, or, whether it's, taking, that luxury vacation, whatever, or give to charity or buy a great piece of real estate or business. So my first interest was in the stock market, and I was day trading, and I was actually making about $1,000 a week as a junior in college, day trading. And that's great, except it's super volatile. and it's super stressful. And I was laying there at like 3 a.m. one morning and just thinking like, this is crazy. I'm 20 years old. Like what happens when I'm 40 years old? Like I'll be dead. So I was like, there's got to be a better way. So I just started reading book after book after book. I was reading over a book a week. I read over 250 books on the stock market, money, finance, business, real estate, all these different things. And when I started to really dive into real estate, it seemed simple to me because my parents had a few rentals, but it's like, wait a minute, I can negotiate the sales price, the purchase price. I can get financing. I can leverage. I can improve the property, like all these things, this control, right, really, really appealed to me.
Yeah.
Cash flow. And I was like, okay, so I bought my first property at 21. And then, I said, okay, just real simple. I said, I'm going to buy enough properties that have $10,000 a month coming in after I pay off the debt. So not even after debt service, like, hey, after paying off the debt, and that's it. I'll be free. So, and then I set off to get, a job that I can make enough money to continue to buy real estate. So that was my initial simple plan when it came to investing in real estate.
Do you think that your experience in the stock market then helped you with real estate? Because what I always say is that real estate versus stocks, real estate's tangible. Like you said, you can fix it up and then it's worth more and you contributed to it. In stocks, like you're saying, you're sitting there, you don't have any control.
Right.
It could go down, it could go up, but you can't directly influence any of that. And then when someone who's in stocks then gets to real estate, it becomes like this, like, you're in search of this freedom and ability to create something yourself. Real estate does that because it's like you're negotiating prices, which helps you later in appreciation. Was that something that immediately started to make it a little bit more interesting to you?
100%. I think the perspective too, when you realize like how volatile it is, and it's like, sure, you can make a lot, but a lot of this is speculation. Unless you're, like Warren Buffett and you're like literally buying chunks of businesses,
right?
Or Sam Zell, where God rest his soul, but you're taking over, a business or buying a business out. Like that's different, right? Or you're Gordon Gekko and you're trading on insider information. Or I guess, hey, you know what? I could go and be elected to like the House or Senate and then trade on insider information. Then I wouldn't be
right.
It wouldn't be illegal.
Yeah,
that's another topic, Jonathan. But
of course,
no. But yes, I like the control, and this I mentioned. Kind of talking about how I formulated the framework around investing, and the first thing is I try to figure out a career to make money. I was reading different books, and one of the books, I believe it was the author of The Millionaire Next Door, and one of his books, he talked about demographics. I was like, I started to read about demographics. And then Harry S. Dent also wrote about demographics. So I started kind of catching these things where people said, hey, just follow the baby boomers and what they're doing and what they need. Yeah. And that's why I got into the medical device industry, because baby boomers, the most affluent, active generation in history. I thought, hey, they're going to want to continue to be active. They're going to need surgery. They're going to have surgery, and they're going to continue to go on and be active. So I got into orthopedic sales, and that turned out to be a nice, stable, growing business. And I took the same demographic information, and that's how we got into apartments, because we said, oh, look at the millennials. They're renting in larger numbers than ever before. Yeah. Now, what's interesting is the baby boomers are the fastest growing renter demographic. So I said, okay, I'm going to use demographics as an arrow for what area to go in real estate. And then I'm going to find an area of real estate where I can preserve my capital, because I'd seen my capital go disappear overnight, in the stock market. So number one, preserve capital. Number two, generate income, because I believe that you can't be truly free unless you have passive income. And then number three is, I think it's number, am I keeping up here? Generate appreciation, right? And I really like real estate where you can force appreciation. So you can negotiate on the front end, but then can you force the appreciation? Can you create value in that specific piece of real estate? And then can you do it in a tax efficient manner? So that's the framework I use when I look at investments. And the neat thing is, it was developed through real estate, Jonathan, but also it can be applied to businesses as well.
Yeah, absolutely. And you talked about demographics a lot in that research. Do you believe that a lot of people use kind of what I call the Starbucks or Trader Joe's philosophy now, because they do such demographic research. And I think that's a really smart play, because that's exactly what they're doing. So when you see, in my mind, if you could know, like that a Starbucks coming in 6 months and nobody else knows, like you should just be buying up in that area. They've done all the research for you. Do you subscribe to that philosophy and think that that would work?
Yeah, look, again, and this isn't this isn't magic, right? We can all figure this out. I was just reading an article today. It said, "Hey, look where," or was it yesterday? I'm sorry, it was a book yesterday. It was talking about following infrastructure investment from the government, and like that's where future development's going to be. So that's a way to kind of see the future. And look, if you're listening, here's a really simple way to figure this out. So I live in Asheville, North Carolina, and people are like, "Wow, you bought a property over there. Now it's a super hot area. Then you bought a property here, and that's a super hot. Like, how did you figure this out? You must just be lucky. How do you get?" I'm like, "No." I'm like, "Whoa." I'm like, I just went on the city website, and I said, "Hey, they have a 20 or 30-year development plan." And I just looked at where their current development plan was, or where the next one was going to be.
Yeah,
and I just bought in that area, and they're like, "I didn't even know that existed." I'm like, it exists everywhere pretty much. So, you can do it from a macro perspective. You can say, "Hey, what is this generation doing in terms of real estate?" You can do it on a local perspective and look where the government is spending infrastructure dollars, in your own city or state, and you can do money there. It's not that hard to do. And look, I bet on big trends. I don't bet on small trends. So I'm not trying to figure out and time like what's going to be the hottest investment today or this week or even this year. I want to know, hey, can I bet on this strategy for the next 5-10 years? And, look, if I'm off by a few years, that's okay. But, if the tide is rolling in and I'm riding that wave, then that's great.
Yeah. And I mean, local investing and knowing your market's so important. Well, because in my opinion, it's pretty hard to like lose a ton of money on real estate if you're buying correctly, because you still have the asset and the land. So if you're buying in the areas and you're doing the research, the chances of you going, like, sure, an economic downturn can happen, but if you did it right, that market's still a growing market at some point, even if it slows down. Did you find that, is it easier for you though in the syndications? How are you figuring out which areas you're going to go to? Because obviously you don't stay local for those.
Correct. Yeah. So we're regional, but it's the same. It's the same formula. Okay. So you're right. If you buy in an area that has, and we have like 36 different metrics that we use now, and we focus on typically large growing cities in the Southeast. So if you buy in a city or a metropolitan statistical area, an MSA, that is growing, that has growing population, growing faster than the national average, if it has job growth that's faster than the national average, and you have a favorable business climate where the state is doing things like providing tax incentives for people to move there, whether that's a low state tax or low business tax, those sorts of things, like those are tailwinds, right? That's the tide that you're riding in. So we look for those sorts of things. Then we layer things on top of that. We look at the demographics within 5 miles, 3 miles, 1 mile. We look at supply and demand and those sorts of things. So those are all very important. But just from an overall perspective, if you have a lot of stuff on your side and you buy at a price that is lower than the market price, or at or lower than the market price, with reasonable debt, so like let's say 50 to 75% loan to value, and your cash flow covers your debt service and more. And so, okay, let's say your plan is to hold it for 5 years, but maybe you sell it in 3 years, maybe you sell it in 7 years, maybe 8 years. Does it really matter? I mean, yes, it matters for the return, but it's hard to lose money in that scenario, or lose a lot of money if you keep and stick to those rules. And again, we focus on the value add strategy, which is buying stabilized assets that then maybe need a little bit of work, need a little bit of capital injection, but are already cash flow positive.
Yeah, that makes sense. I mean, I prescribe to the term asset hunting for everything, because I feel like people get a little too deep in the spreadsheets. Obviously, for large scale commercial, like a spreadsheet's going to be important because you want to know what the general numbers are. But I think when you have to be able to step outside the numbers and look at, is this an asset that I want to own? Can this be, like you said, what if I add value to this asset? Then it's going to be very, very good, where these people can't see how good it can be yet. That's where your biggest scale is, on finding stuff that the other people either don't want to do or can't envision. Or like you said, you're doing the data, you understand that the plan's going in a way that's going to help this development, but these owners don't care. They're just trying to get out.
Right. Yeah. And that's the thing. So we are, actually, I just got a message we're finalizing a contract on a mobile home park today. And what we find typically in the parks that we're buying, Jonathan, is the owners, they've held it for a long period of time. There's smaller owners typically. We're buying parks that are, a couple million, anywhere from $1 million up to say $10 million. So you get these smaller owners. These are really, really strong cash flow, little cash cows, right? So they're kicking off a lot of cash. But what happens over time is the parks go down in quality. And then it costs more and more, especially in today's environment with inflation and everything, to improve them. That's everything from landscaping to the homes themselves. In a lot of cases, you can't even get the homes or get financing to put these homes in place. So it's not uncommon for us to buy these parks at say, 50% occupancy. And it takes a lot of money, hundreds of thousands of dollars for even a small park to just bring it up to proper occupancy and do that. So if you can come in with the right plan in place and the right capital on the front end, you can give these sellers a really good return because in a lot of cases they own the park outright. They pay down the note over a long period of time. They're getting a good deal because they can't improve the park from where they are. And then we turn the park and turn it into a better version of what it was. So the residents benefit, our investors benefit. It's just a win-win all around. So that's a good example, like you said, of, finding something where, you're buying it undervalued, but the current owner doesn't have the ability to bring it up to the value that it should be.
Yeah, or age-wise, they're kind of scaled out of it. They don't want to do another big project. Like
maybe they're looking to retire even.
They've done fine. But that's what I like what you said. It's why you can get it for, 50% is because they've made plenty of money. They own it outright. They're just looking for someone at this point to take it off their hands for a reasonable price. And those negotiations are much easier, especially like you said, you're in the $1 to $10 million range. There's not like a million spots. Like it's as big as it's going to get. So it's manageable. But I do think for new investors, I think they need to know like the changeover, like you said, in the upgrade, even in mobile home game, is a lot because now you're building more amenities and things that are going to be more attractive to a younger subset of people who might find this interesting because no one can buy a house right now, allegedly.
Well, look, I think one of the big areas, if you look at trends is affordable housing. Yeah. And, if you can find an area where you can create more affordable housing, whether it's mobile home parks or it's apartments that are below market rent or, it's starter homes or like tiny homes in some scenarios, like all these are providing a real need, right? We have a need for over 4 million apartment units in this country. The city of Houston itself needs like 600,000 affordable units. I mean, it's crazy, the issue that we're having right now. So there's a lot of areas there, but you have to get creative because obviously what we're doing today is not solving the problem. So that means if you're listening, if you have an option, if you can get creative and solve this problem or bring together, some like we do, we're taking, our formula from the multifamily space and we're able to, leverage that into the mobile home park space, then we can solve that problem where some people may not be looking there. And that's the other thing. Like if everybody's doing it, maybe the area of opportunity is not quite there. So, don't shy away from areas where people aren't clamoring for it just yet.
I completely agree with that. That's how I feel about neighborhoods, though, too. We were talking about before. I feel like people are overlooking the up and coming, the one like the neighborhood behind the neighborhood. They're all in the neighborhood. Like everyone's like, hey, do you want to invest in Austin? I'm like, why would I invest in Austin? Like, it's cool, but like everybody's been investing there. So where do I want to go? Austin's huge. People don't realize how big it is. If you're
like go down the road to like New Braunfels or something.
Yeah, there's so many different levels to that type of market, and I feel like that's involved in every town. I have a question for you though. So in the current market, we have interest rates high, we have commercial real estate struggling, but still somehow priced too high. What's the asset class that you as a syndicator are looking for right now? You have different asset classes. You have multifamily, self-storage, mobile home parks. What's an asset class that you think is an opportunity right now where it's a little bit crazy, the market's a little bit nuts?
Senior housing.
Oh, great.
Yeah. So I think right now I would call it operating real estate is where there's a lot of opportunity. So you're right. Prices are at record highs, especially for residential properties. I still think like multifamily is a very secure place with high quality properties to put your capital. But look, if you're getting a 50% LTV loan and you're bringing more equity to the table, then necessarily your cash flow is going to be lower because you have higher debt service, and ultimately your returns are going to be lower on the back end. So what's interesting is that same property, a couple years ago, if you could buy it at a 75% LTV, the returns are going to be, say, 15%. And, now they might be, low teens or 10%, but it's potentially a safer play, because if it's only 50% leveraged and you have decent cash flow, well, that's a solid deal if you have long-term, debt on that property. But how do you create additional cash flow? Like, where do you find cash flow? Where do you find returns? I mentioned deep value add mobile home parks. Car washes is a space which is, I would call it operating real estate. You have this business, where you can pull different levers, and private equity is getting into it. But I don't think people are looking at senior housing because, I started looking at this market about 5 years ago, almost pulled the trigger on a couple projects pre-COVID. Thank goodness.
Yeah.
Kind of hit the brakes on that. Yeah, it was, it's very unfortunate. I mean, look, in that industry, your attrition, or in that asset class, your attrition rate is about 20% a year. So you're losing 20% of your residents annually. Yeah. If you're locked down for 2 years and your average occupancy is 95%, well, next thing you know, you turn around and 2 years later, you're at 50-some% occupancy in most of these properties. So, there's a lot out there that are struggling. But again, going back to demographics, going back to that original framework, all I do is say, hey, what demographic is about to, where's this demographic about to explode? Baby boomers are retiring 10,000 a day. Well, what's the next? What are they looking for right now? They're looking for independent living communities, which translates into assisted living communities, which translates into memory care and skilled nursing facilities. So, if you have a lot of these communities right now that are struggling, these properties that are struggling, and we have a massive need, a massive shortage that is about to hit us as these baby boomers come upon us, we're going to have an absolute crisis in that space. So if you can foresee that, which I'm telling you how you can foresee that very simply right now, the demand is going to be there. It's not there yet. And the supply is not there. You can solve that problem. And I think you can do very well. The crux is you've got to be with a really good operator, because that's not a simple area to operate in. Just like, owning a car wash, it sounds cool. It's like, hey, we can have a lot of cash flow with this business. But if you don't know what you're doing, then you're not going to make money.
Yeah. Yeah, I agree. I mean, I think that applies to a lot of the hybrid real estate business assets, like a car wash. Like, you're not really sure what you're getting into. You can buy a good spreadsheet, but you can immediately terminate that spreadsheet by bad running it. And then you're decreasing what's coming the next 3 years, because now you're getting all bad reviews. Nobody wants to go there. Service is terrible. I mean, that's what I think. Yeah, that's what when private equity starts to get into a field, it does make me a little nervous, because I feel like they're going to kind of ruin it. I look at like the iBuyer situation that happened in Arizona, and I'm like, well, this is getting uncomfortable. Like, we're still going with this. What do you think about that?
Well, so it's good if if private equity is getting in when you're getting out.
Yeah, right. Yeah, exactly. Yeah, or they get in and you get right out. You on the coattails of their overpaying, you can just check right out.
Well, and look, that's another area. So I like to be in industries where, if I say, okay, so one of the things I like to do, look, mobile home parks is a great option. If you look at the mom and pops that own mobile home parks, it's like 3/4 of these parks are owned by mom and pops, smaller operators. It's the same thing with car washes. So there's an area of consolidation. Like, private equity is going to take a while to gobble up, large institutions are going to take a while to gobble up, these mobile home parks. They don't want to buy the parks that we're buying because they're too small. Correct. They're too much work.
Exactly.
They're a pain in the butt. And frankly, the numbers are not going to work for them because, they don't have the vertically integrated systems and teams that we do. So, it takes, and same thing with the car washes. We own the operating company. So if you're gonna go and buy into a franchise or do something like that, well, that's going to be different. Or you're the operator. So if you want to get into short-term rentals or car washes or senior housing, then you either better be really good at operating, or you better have a partner that's really good at operating. Because if you're depending on a third party to operate, like we do for our apartments, you're gonna be in trouble. But I call them off-the-shelf management companies, right? If there's a lot of off-the-shelf, high-quality management companies, then that tells you something about that space. It's probably fairly mature, So I look for those areas as well because, you see if you can make 20% returns and, you can sell to somebody that's looking for 10% returns, well, that's a large spread there, right? So there's a lot of meat on the bone.
Yeah, I would liken those couple that we were just talking about also to self-storage too, because like when we run our list for self-storage, we only look mom and pop because private equity is buying all the ones. If they own 5 or more, there's no reason to call on those. We're just looking for one, just like mobile home parks for the same reason. The meat's
Bingo.
not on the bone for the private equity to go get this little thing with, where you go in and their ledgers are still in pencil. You're like, this is for me.
Bingo.
Yeah, this looks great.
Yeah.
I'm not going to be able to make sense of it for a long time when you're doing due diligence. But yeah, I think that's interesting. And I think self-storage, fits into your model. Obviously, you guys have that as well. Today's show is brought to you by Streamline Properties on Market, brokered by eXp Realty. That is my on-market real estate team. We are investor friendly. We work traditional buyers, sellers, but we also work the investor sphere all the time. House hacking, short-term rentals, flipping, long-term holds, anything that you want to do. We're experienced in that arena. We work the whole state of New Jersey, Philadelphia County in Pennsylvania, Elko County in Nevada, and the Catskills region of New York. So whatever your investor needs are, you can count on us. You can go to streamlined with a D .properties. Let's get back to the show. I think it's important for investors, even if they're new, to start understanding what all the asset classes are out there, because maybe they don't have 100%. The time to go in and they want to do passive and invest in syndications and have experienced operators make them the money in a safer way. Something interesting though, because you were saying before, like your original goals were really for your life. It wasn't about the money, but you knew to have the life that you wanted, you needed to get the money in. So your company, Next Level Income, is really about creating a next level life. And you're doing it through real estate, right?
That's absolutely right, Jonathan. Look, we're driven. Again, we believe that to be truly independent, you need passive income. And, our website, if you go to nextlevelincome.com, you're going to find the podcast, you're going to find the blog, you're going to find a copy of our book for free. So if you click on the book link, you put your address in, we will send you a copy to your house for free if you're in North America. My wife's Canadian, so we send to Canada too.
All right. We'll link to it in the show notes.
There you go. We have a course. We have all this material and information that's largely free that you can get and access, and that's to help you move forward on your step to financial independence. We also have the investment opportunities, which you can click on invest and you can talk to our team to see if that's a good fit. But yeah, like you can learn about how to do this all yourself. And look, frankly, you should get better returns if you're doing this by yourself because you're spending your time, your credit, the risk that you're taking to go into these things. And I think, successful investors have a strategy where they do their own deals. And then they also have a strategy where they invest the capital that they're creating, from the deals of the business that they do. And that's a nice scalable strategy. And at some point you say, hey, I want to go sail around the world. I want to spend more time working with charity. I want to coach my son's, team. Whatever that may be, creating these passive income streams is going to give you maximum, flexibility because you can always go back and buy more active deals if you got the capital to do that. But yeah, so that's really our philosophy is, we help people achieve financial independence through education and the opportunities.
Yeah, excellent. So, like as a syndicator, who's your ideal investor? I know like a lot of people will click the button, but like who fits your model? And then how wide does that get? Because it's not for everybody.
No, it's not for everybody. So again, there's a lot of people that are listening that, you're going to be better suited to go out and do your own deals. But like, let's say we have a lot of doctors that are investors, after all the time I spent in the medical device business. Look, if you're a surgeon, you love what you do, but you're making a lot of money and you want to create, these additional passive income streams, that's great. If you're a business owner and you don't have the luxury of having a 401k, or you realize that a 401k isn't maybe a great bet or you don't have the options that you'd prefer to have, you can start to create, your own pension through investing in assets. And actually one of my favorite strategies. So if you're a business owner, you're an entrepreneur, you're a high income earner, and you want to create your own pension, one of the things that I did is I set up a high cash value life insurance policy. And that that gives me literally a guaranteed rate of return and guaranteed amounts of cash flow at specific points in my future. So, and that's something under our banking strategy. So that's something that pretty much anybody that's listening could integrate into their plan when they're doing that. But from an investor perspective, look, if you're a high income professional, if you're accredited, if you're making a couple $100,000 or more a year and you have excess income and want to create more passive income streams, then that's who we like to help out.
Yeah, I really agree with that because the term passive income gets spread across all of real estate investing so much, but there's very little real estate investing that's actually passive. Syndications as an LP, that's really passive income. Your due diligence is all up front on the operator and the asset, but like you're just sitting back and letting it happen and taking your monthly reports. But everything else in real estate is not passive. You know, for people who say like, let me buy a 10-unit apartment building for passive income, like that's going to be the least passive thing you've ever done in your life. You know,
that's a business. Even if you're buying a business,
you hire property management, they don't operate on their own. You're creating another job for yourself, right?
Yeah, that's right. You really, and look, passive income, it's not black or white. It's not active income, passive income. Income is on a scale, right? It's kind of gray. It's like, how gray is it? So, you know, if you have like a 10-unit apartment building that you self-manage and you do all the repairs, that's a job, right? Like that's
Absolutely.
a job. If you invest in a passive syndication in like one of our deals, it's 200 or 300 units and you do all the research up front, you invest and, you know, I hope you read the monthly reports. I hope you read the quarterly reports. I hope you dive in to the operations and the financials as often as possible behind that. But yeah, you could sail around the world for a year and come back and your bank account should be getting those checks, you know, every month, every quarter, you know, depending on the distribution schedule, you know, for that. So, you know, I will push back a little and say, I don't think any investor should be 100% passive. I think they should have at a baseline, you know, a knowledge and understanding of the strategy of the operator and then keep up, you know, with those operations and make sure that things are moving along smoothly. And if they're not, you know, understand why that is. You know, is it because interest rates have increased? Is it because, you know, there's lower occupancy than expected? Is it because operations or renovations have exceeded budget? Why is that? You know, is it because there's the supply chain shutdown during the pandemic? Like there may be reasonable explanations for underperformance or temporary underperformance, but you should understand that too. And if it outperforms, understand, hey, were they good operators or were they just lucky?
Yeah, I think that's a great point. I mean, I was just reading Brian Burke's book also, Hands Off Investor,
great
and
book,
that's really like due diligence on, you know, the operator and understanding what you're getting into. Because I really agree with you that to be just completely passive and have no idea what's even happening with your syndication, like that's not really just invest in stocks then. And, you know, it's going to be a weird return. You could lose money, but like, it just seems like the more you know, the more you're going to know for the next time instead of just blindly. And I feel like the chances of somebody losing on a bad operator are much higher if you're just, you know, fork over the money and like, I'll just see it at the end of the year. Like you said, you're not going to know why, you know, supply chain was down during the pandemic. Like things are going to change in terms of how it's going. So that was a really good point. Yeah, I think that's something that people need to be aware of. And it's also another indication of what we just said a few minutes ago, that syndications aren't really for everybody. It's a great option to have as something. And I like also what you said, that I think it's a perfect match for individuals who are making a good amount of money, but they're working jobs that really have a lot of hours. So they're not going to be able to go do, you know, a couple rehabs or manage 10 units. Yeah, I really like that philosophy.
Yeah, it can help everybody too.
Yeah, absolutely. Absolutely. So where do you guys have investments now in your syndications?
Yeah, so most of our portfolio is up online here. We operate from on the apartment side, the greater Southeast. So we have properties in the Carolinas down to Florida, as well as Texas. On the self-storage side, it's largely the same footprint. We actually have a couple locations in Colorado, mobile home parks, Southeast. We have Nexus in the Carolinas, Tennessee, some other locations. The car washes are a little bit broader because they work in more markets. You don't have to have quite the same demographics. So those are going to be located in Maryland all the way down to Florida as well as Alabama. And that footprint's growing. We just actually added 4 locations yesterday in Greenville, South Carolina.
Oh, awesome. Yeah. I know somebody there as well. Have the crazy insurance rates affected like at least Florida investments? Because I've heard a lot from syndicators like, whoa, okay, Florida, and definitely south, like insurance went up a lot. Yeah. So that can affect the balance of a portfolio that way.
Yeah, it certainly can. You definitely have to underwrite, make sure your insurance rates are, built into that, or large jumps in increase in insurance rates are built into that. When you have a large portfolio, you can get, as we have over 3,000 units, so you can negotiate rates a little bit differently.
Yeah, exactly. Much different than a one-off there. So if there was a new investor getting into the game, maybe they've tried out a couple things and they're looking at syndications, what would you tell them to do first? And this is coming from you as an operator, but how would you advise someone who's newer to it? I know we talked a little bit about it, but this is like direct to the investors. Like, what would you tell them to get started?
Yeah. So first off, you should put your framework, your personal strategy together, right? Now you may say, well, I don't even know where to start with that, Chris. So, you can start by talking to syndicators or operators and saying, well, what is your strategy? Like, tell me about your framework and your strategy for an investment. As I mentioned, earlier in the show, ours is built on demographics, and then we talk, we kind of go down the spectrum there. You have operators out there, syndicators that are doing more developmental type deals, right? That's going to be a little different. And I've talked to investors and they're like, Chris, I want to invest in a deal that's less than a 30% projected return. And I'm like, wow, like that sounds pretty good. Can you share with me, some of these deals you're looking at? And they send them to me. And they're development deals that there's no cash flow for 2 years.
Yeah.
Well, that's a lot different than investing in one of our deals that is immediately kicking off cash flow the month after you invest with us, right? Like totally different. So, you can't compare apples to oranges and do that because, it's not going to be a fair comparison. Now, you can certainly invest in different portions of your portfolio with that. But the problem I see most investors do is the first thing they do is look at the returns. That is the absolute last thing you can do because it probably is irrelevant. What I mean is, like, I can change things on my spreadsheet all I want, and I can make those returns change. Yeah. If I assume a refinance or change the year it's going to refinance or change the interest rate or the cap rate, I can increase my returns or decrease them 50%. It's crazy. So first off, come up with your strategy. If you don't have a strategy, talk to different syndicators or operators and ask about their strategy. So then, that can help you formulate yours. Start, you hear me on this podcast, you could reach out to us and look at our different deals, look through different deals, start to vet the syndicators. We actually, in our course, and you can actually just buy the spreadsheet, we have a spreadsheet called the LP Deal Analyzer, Jonathan, and we give you the questions. We give you a summary of questions, and then we give you, like if you're an engineer like me and you're a little crazy, we have all the questions you can ask where, because that's the problem. If you don't know the right questions you ask, your answers may not make any sense.
Yeah.
So once you know your strategy, once you have an idea of the syndicators, and by the way, the strategy should also include geography because you want to make sure you say, hey, I'm only going to invest in deals that are in markets that are, say, over 1 million people, that sort of thing. You have syndicators that you trust that you can work with. You start to talk to them. I mean, I looked at deals for about a year before I invested in my first deal. You certainly don't have to wait that long, but I looked at deal after deal after deal to kind of formulate my strategy and make sure I trusted the operations and those sorts of things. And then once you have that figured out, you can start to look at individual deals. And what I would say is look at a deal, set up a call with whoever the sponsor of that deal is, ask them a lot of questions and make sure you're comfortable with those questions. If they can't answer a question or, they're not responsive, anything like that, if it's not comfortable, move on.
Yeah.
Right. If you say, let's say, I don't like the politics in Florida. Okay. Don't invest in Florida.
Yeah.
I have investors who are like, oh, I would never invest in Florida. I'm like, okay, don't invest in Florida.
Right.
What do I care?
Yeah.
That's fine. That's your money.
Yeah.
It's your money.
Pick
that's
a different spot.
Yeah. Chris, I'll never invest in mobile home parks. Like that's not something. Okay. That's fine. Then that's not a good fit for you. And I certainly am never going to try to convince an investor to go against, their internal feelings there. Like you want a sponsor, you want an operator that is aligned with you, your strategy, your values, all those different things, and ask lots of questions. And then, and only then, would I look at the returns and say, okay, is this a reasonable return? And look, a lot of times you're going to look at these deals and say, wow, this is like way better than I get in the stock market. But remember, you want to ask, how am I going to get my money back? how can I get my money back? And that's the final point. Usually there's what I would call a liquidity premium. So if you're locking up your money for 5 years, well, you should get a higher return than you get in the stock market, right? Because you're giving that money up from with respect to the ability to spend it or invest it in your kid's college education or that sort of thing. So ask that as well when you're like, hey, Chris, when am I going to get my money back? How can I get my money back? When are we expected to sell it? Make sure you understand that aspect as well. Too quick isn't great and too long isn't great either, because you want deals that you can investigate and look into. If you got your money turning every few months, that's a lot of work, right? Yeah. So you want a strategy you can invest in, you can continue to invest in that makes sense with your timeline. Yeah. We talked about your course a little. So tell us a little bit about the 6 figures of passive income roadmap, how it works and how people get into that. Yeah. So look, my coaching clients, it's about $30,000 a year to work with us. And, the problem is we can't work with everybody that reaches out to us. And then the other problem is there's some people where that amount doesn't make sense. So we wanted something that provided the framework that you could build your own strategy. Maybe you're just getting started and you say, hey, Chris, I just need to figure out how can I make more money? Or maybe you say, hey, I need to optimize my tax strategy, or I need to set up the right entity structures. We teach you how to do all of that in the course. We give you all the resources, and then how to analyze deals. We mentioned the LP deal analyzer earlier. So if you get the course, it's $14.97, but if you use the code NEXTLEVEL, all caps, it'll give you $500 off that course. And if you subscribe to our podcast, you should get that code as part of the email follow-up with that. But it's going to help you not only formulate your plan for financial independence, but it's also going to help you decide, should you be an active investor? Should you be a passive investor? And ultimately, all those questions to ask. And it's going to give you a spreadsheet that helps you calculate how long is it going to take you to become financially independent. And what I found is most of my coaching clients, if you're accredited, if you're making decent money and you're not living way above your means, almost everybody can become financially independent in about 7 years. Yeah. By making the right choices, doing due diligence, like we've been talking about. I think that's important too. Yeah. 100%. And having real life referrals. When somebody tells you, hey, I have my money in this, that's a great warm referral for you as a syndicator, but also for the next client, because that's a peer-to-peer. And the investing game, I guess people think it's huge, but it's not. All the investors end up knowing other investors. And that helps you with syndications too, because you're quickly able to vet, did you get paid on time? Were there any hiccups? How did they handle the hiccups? What's the information flow like? Are you getting your monthly reports? Do they have anything relevant in them? And that's, like you said, that's for what we want. Even the people who maybe want to be passive, they should still be involved in those reports so they understand what's going on with their money. Absolutely. Strategy, track record, communication, and also, like you mentioned, those relationships and referrals, those are all really important things. And look, if no one knows that operator that you're talking to, you can ask them, say, hey, tell me, like, what's your worst performing deal? Yeah. You can say, hey, what's the worst deal you've had? But like, what's your worst performing deal? Why is that? Don't be afraid to ask that question. They sure shouldn't be afraid to answer it. Yeah. I mean, it's an immediate red flag. If, all my deals are great. Okay. I guess this is going to be the first one. Yeah, it's either you probably haven't been doing it that long, or you're lucky, and maybe they are just lucky and that sort of thing. But it's good to have some hiccups, because then look, adversity creates strength, right? And that's really important. Yeah, I agree. Awesome. The best place for people to get in touch with you, nextlevelincome.com. Absolutely, yeah. So mentioned a lot of free resources today. You can subscribe to our podcast. You can get a free copy of our book there. You can get a discounted version of our course. You can also learn about our investments. You can check out our portfolio. Click on the invest link if you want to learn more about what we talked about today, Jonathan. Yeah, awesome. And to get the book, they'll go to nextlevelincome.com/book. That is the shortcut to take you right there. Yes, sir. Yeah, awesome. Yeah, and the book is also called Next Level Income, correct? Absolutely. Yeah, fantastic. Chris, it was a pleasure to meet you. I look forward to staying in touch, and thanks so much for dropping your knowledge on all of our guests. Likewise, Jonathan. Thanks for what you do, man. It's awesome being here. Yeah, appreciate it. All right, that was episode 63 of Zen and the Art of Real Estate Investing with my guest, Chris Larsen from Next Level Income. I'm Jonathan Green. We'll see you next week.
I hope you enjoyed that episode of Zen and the Art of Real Estate Investing with me, Jonathan Green. And I just want to remind you, and this is always an uncomfortable part, I don't want you to think that I'm begging for you to like, subscribe, follow, do whatever you have to do for the podcast, leave a 5-star review. But if you like the podcast and you think it adds value in the real estate investing sphere, then just do me a personal favor. Like the podcast, follow it, share it when you can with your friends, and be so kind as to write a 5-star review if you believe it deserves a 5-star review up against what else is out there. I would really appreciate it, and I hope you keep listening.